Hi everyone, welcome to tonight's webinar. We're just waiting on Kathy. Whenever you're ready, Kathy, feel free to take it away.
Okay, thank you everyone for having me this evening. It's morning time here in New York for me, but I'm always delighted to join all of you to share some of my insights on what's going on in the FX markets and also, what type of strategies you can use to trade currencies. And I think that there's really no better time to talk about techniques for picking tops and bottoms than right now because we have very exaggerated moves in the Australian dollar, in the euro, in the US dollar. In many cases, they're hitting multi-month or multi-year highs or 1 year highs in some case. And so it's important to consider, ways to pick tops and bottoms rather than just arbitrarily saying, wow, the Australian dollar is cheap, or wow, the euro, can't stay at 115 forever. Because if there's one thing that, you may or may not know with currencies is that, they can remain in an uptrend or a downtrend for a very long period of time, and these moves can be much more exaggerated than you and I would expect because usually it's driven by economic or political factors that do not change on a dime. Although these days with the US president, things can really change on a dime. Before we get too much into it, I'd like to share with you this disclaimer that says trading Forex carries a high level of risk and may not be suitable for all investors. So if you are watching this video on demand, please pause the screen, read through the disclaimer thoroughly before moving forward. It basically says that, before you consider any types of trades, make sure you consider your own investment objectives, level of experience, and risk appetite. So, let's start talking about why picking the tops and bottoms is so popular. And I'm sure many of you are watching the charts these days and thinking about picking a top or bottom, and thinking about when you should do it, where you should do it, and the reason is because many of us, or most of us, like to think like contrarians. Like in many ways, we know better. It's for example, if you're watching the dollar, you may be thinking the U.S. dollar, it can't keep on going up forever, given all of the antagonism that U.S. President Trump is having to the rest of the world and all the trouble he's stirring up for everyone. And so, those are the things that people think about. Or, if you're watching, or if you were watching Bitcoin, you may be thinking, wow, it's used to be trading at I think like as high as 17,000, and you may be thinking to yourself, at 6,000, it's a great value. Actually, it traded as high as 20,000, and you may be thinking to yourself, 6,000 is a great value, and so it can't just keep falling, especially when it was 20,000. And maybe I should get in now, so that I can get a great deal, because we all like to think like contrarians. We all like to think that we're smarter than everyone else. And, and sometimes, we are, but most of the time the herd mentality is there for a reason, and the herd mentality lasts for, longer than we would anticipate. But we like to think that, we're, that good things can't last forever, or bad things can't last forever. And that's why picking tops up, we tend to take and translate that type of sentiment into trading, because we like to think like contrarians. It's also because many technical indicators are mean reversion indicators, meaning that they're designed to help you pick tops and bottoms. But not all indicators are made alike, and so we'll talk about different ways to use the indicators and what some of the more popular indicators are, or the most, actually not popular, because popular doesn't matter as much as effective. So we'll talk about what the most effective indicators are as we as we go through our discussion. But in terms of the common indicators, or the ones that we're going to talk about, the ones that I think I like the most and I think are the most valuable are the relative strength index, stochastics, and Bollinger Bands. So we're going to use some of these indicators and turn them into trading strategies to help us trade. We also like, or picking tops and bottoms is also very popular, because not only do individual investors, traders look for ways and points to pick tops and bottoms, but even hedge funds do it. Hedge funds have so many strategies to help to identify what we call mean reversion trades. And I do have a strategy that also does that, and can help you do that. But the whole idea behind a mean reversion strategy is that, let's say a currency is moving lower and the move is getting very exaggerated. The whole point of a mean reversion strategy is that it's going to get back to the mean, the average at some point. And that's really a lot of times the main technique that the algos use. Now, they may use it on a micro basis, on a very short-term basis, but nonetheless, regardless, it is usually a very common strategy for these investors and these traders. So that's what you want to think about. That's what we like to look into, and I think that that's why picking tops and bottoms are so popular, because both retail investors as well as hedge funds do it. But there's one thing that I think is very important to know about picking tops and bottoms before we get into the trading strategies. And what that is that you need to know the difference, or you need to discern how you want to pick that top and bottom. Do you want to scalp versus trade? Or do you want to scalp and trade the top and bottom? Or do you want to try to pick a major reversal? Because the tactics that you use for these different types of setups and can be very different. Now, range trading is for those of you that are into scalping, going for usually smaller moves within a very well defined range. Reversals are for those of you that like to invest, or to trade or invest, that are looking for much bigger moves. So they are very different, and it's important to realize that you're looking for your stops should be placed at different levels. You're looking for exhaustion points from a different perspective. So if you're into range trading, which actually is not in an environment that that happens. Well, it happens probably just as much as trend, but not an environment that's been happening as much lately. What you want to do is, quite simply, you want to fade highs and lows. Now, that may seem, very obvious at first glance, but what may not be as obvious is that one of the more common tactics for picking tops and bottoms in a range is basically using multiple entries. You may look to add to your positions up to the range limits. So you may be looking to add to your positions up to the range limits, which means that if you're in a well-defined range, sometimes it doesn't always get to the bottom of the range before it kind of reverses back to the top. So at some point, maybe at 75% to the bottom of the range, you may start to enter your position, and you may add to it up to the bottom of the range with your stop, below the bottom of the range. Now, the disadvantage, in my opinion, of trading ranges is that you have to have short targets and tight stops. And unlike the entry, where you may be using multiple entries in order to get yourself into the range trade, with range trading, you want to have a single exit. I mean, you could exit on a tiered basis, exit as you get closer to the top of the range. But pretty much you want to exit most of your position near the top of the range, because the whole premise of this is that you're thinking that it won't get much more beyond the top of the range, and that the range that you've been seeing before will be maintained. I mean, that's the whole thesis behind range trading. So you can, just to recap this, you can enter on a multiple entry perspective, but you want to exit, pretty much at the top of the range. You just want to keep your stops right below, outside the range, and you want to have short targets because you're not looking for a very big move. And this is perfect for those of you that are day traders, because as a day trader, you're just looking to get in, get out. You're not looking for much. And so I think that, that's very popular. And, that's something that a lot of people, pay attention to. And that's basically, what you can kind of focus on a day trading basis. Now, reversal is different, and I personally like to trade reversals a lot more. If you attended Boris's webinar, he's much more of a day trader. So he looks for things on a very more micro perspective. And I do also day trade, but what I really love is trading on a swing basis and looking for some of these reversal opportunities. Unlike range trading, reversals are usually triggered off of a very exaggerated move and driven by a sentiment change. So it's on a chart that looks very, very different, where you're looking for a very, very big move, and then you're looking for a reversal off of that move. And what's really great about that is that, first of all, you have single entry. So it's not as if you're scaling in to a position and therefore increasing your exposure as a result of scaling into the position. What you're doing is you're entering the whole position at one price, and then you are scaling out of the position. So you're entering the whole position at one price, and you're giving yourself the opportunity to scale out into profits, because sometimes the reversal, and usually it takes a very long, it takes a while for the entire reversal to happen, but sometimes a reversal will give you a small amount of pips, and it's usually not too small. I would say 70 to 100 pips. Sometimes it will give you a couple hundred pips. So it really depends on the trade. It depends upon the environment. And so having single entry, multiple exits allow you to bank some decent profits and try to trail your stop on the remainder of your position if the market is so generous enough to give you those profits. So with trading reversals, it's a tiered exit. And what's really great, and why I really like trading reversals, especially with some of the strategies I'll show you, is that the stops tend to be very tight. I mean, they tend to be very obvious stops, usually the swing high, swing low, which usually is not that far away, and the risk reward is far more ideal. Reversals are perfect for swing traders. And for those of you that don't want to stare at the screen hours on ends and just obsess about it, for those of you that really want to, focus on the big opportunities and maybe only check it once or twice a day maximum. So the best currencies, there are different currencies that work well for range versus reversal. The best currencies for range are the ones where the countries are very much correlated. So, and of course, political factors could change and affect this as well. But the best currencies for range are pairs like Euro Swiss, Euro Pound, Aussie Kiwi, on a swing basis. Although, today we've got the Bank of England rate decision, and you can certainly expect some, potentially breakout moves in sterling as a result of the Bank of England rate decision. Also, recently we've been having a lot of political trouble in the Eurozone. It started with Italy, then with Spain, and now Germany, and so that's creating some currency-specific movements in the euro. But if you take a look at it from a bird's eye view and from a longer term perspective, these are the pairs that tend to do much better on a range basis. On a day-to-day basis, I also like to trade euro or the Swiss crosses, like Aussie Swiss, on an intraday basis, because they tend to move in the direction of, or even Euro Aussie, Euro Kiwi, because they tend to move in the direction of risk, especially during the European and New York sessions, where the market is either in a quote-unquote risk-on mode, and they're just selling the US dollar against everything, against the euro, against the Aussie, against the Kiwi, against the Canadian dollar, and so it just becomes a relative bet of, which one's worse, the euro or the Kiwi, for example, and during the New York session. But on a swing basis, there are bigger factors that can affect the currency. Pairs that are really good for reversals, are the ones that are, usually higher volatility, like the pound pairs, the yen pairs, like pound dollar, pound Aussie, dollar yen, Aussie yen, euro dollar, pound dollar. Dollar pairs themselves tend to be very, very suitable for reversal trading. Now, what we're going to talk about next is what technical indicators and or what chart patterns are the most reliable for picking tops and bottoms. And then after that, I'll share with you some strategies that you can use to pick tops and bottoms using specific technical indicators. And we'll look at some charts while we're doing that. Okay, so one of the most common, and there are plenty of indicators to pick tops and bottoms, but these are just what I feel are some of the most reliable. And we're going to look at first the head and shoulders pattern. The head and shoulders pattern is very, very popular in picking tops and bottoms, but it's a long setup. It takes a while to form because there's a couple of things that you need to look for. You need to first look for a really nice rally that forms a top, and then you need to look for decline that's about 50% of the initial move, and of course it's never perfectly 50%, but you want to look for a decline that's probably about 50% of the move. Then you want to look for a recovery, and that recovery usually takes you close to the first top. It's like I said, it's never perfect, it's never exactly the first top, but it tends to get quite close to that. So, you're looking for maybe the first top that is, it usually doesn't exceed, the second top usually does not exceed the first top. If it does, it's probably not as reliable of a setup. But if it peters out right underneath the first top and starts to fall and it breaks the neckline, that's when the double top is confirmed. And when you get a triple top, that's even better. So here, what you can see is my first arrows, you have the first top. But the problem is that the neckline is developed here, right around 127. I wonder if I can get like an arrow going. Oh, sorry, that's not what I wanted. I want to see if I can get a spotlight or, okay, so it doesn't seem like my spotlights or arrows are working, but pretty much after the first arrow, right around 127 is the neckline. And then it forms another top, a smaller one, but that's not really that significant. But interestingly enough, the neckline continues to hold. And the next one, we get another top and it drops a little bit. And the neckline is broken, but it doesn't break it on a closing basis. And that's really important. And it certainly doesn't break it with a very negative candle. So then you, if you took this trade, maybe you've been stopped out, but by the time we have a third top, we get a close below the neckline, which is right around, I would say, if you're looking 1, 2, 3, 4, it's the 5th red candle down from the right arrow that you're looking at. That's when you get the real break, and then it becomes a more confirmed top in the currency pair. And with the picking tops and bottoms using the head and shoulders pattern, this is a setup that on the daily chart you only see once in a while. It's not a setup that you see very often on the daily chart, but you may see it more often, for example, on the 4-hour chart. I would not use this for anything less than a 4-hour chart, because I don't think it's as reliable on a 4-hour chart. But I do want to, on a 1-hour chart, but I do want to show you this in a live example on, let me just get rid of some of these indicators, on pound dollar 4-hour chart that actually happened recently. And you don't see it, this is my e-signal charting package. Let's see if we can find, if you look at it from a more micro perspective, on my other charting package, it looks like we had a setup more recently. But this is a classic head and shoulders pattern here. Let's see if we can find the tops and bottoms. As you can see in the 4-hour chart, you don't always get such a, you don't always get the setup happening so often. But here's a potential example. Now, of course, when you're trading 4-hour charts, you're not going to expect as much as if you're trading daily charts. But here you get a rally, you get necklines established, you get another rally, and it breaks the neckline on a closing basis here. So you would have sold maybe 109.75, and you got a 25 pip move because it wasn't a hugely generous move. Let's see if we see another example. So this is another example on a much more longer term basis in dollar yen. So you have a top here, and the neckline is established here. You have another top here, and the neckline is established here. So you may ask yourself, where do you put your stop? So you've got to put your stop at the 50% point of this move. That's when the break is quote unquote happens or real. So when do you get the break on a closing basis? Well, this is a break, but it's not really a confirmed break, because it's a doji candle, which is actually a reversal candle. So these are not confirmed breaks yet. So the first time you really have more of a confirmed break is this candle here, because that's when you get, or better yet, this candle here. But either way, because this is when you actually get a long red candle, whereas a lot of these, like this is a doji candle, these are really indecision candles, but either this one or this one is where you get a confirmed break. And here it closes at 108.40, and then it has about 100 pip move lower. Picking tops and bottoms, as I said before, you're going against the trend, so you don't always get a really big move, but in the Eurodollar example before, we did have a really nice move. One pattern that you see that I like more than picking tops and bottoms is actually the shooting star. And we'll see a lot more examples with the shooting star setup. But the whole idea with the shooting star setup is that you've got a nice exaggerated move, and then in a uptrend, the currency makes a new high, but ends up closing that day near the low. And so the candle, or the body of the candle, is very much the bottom of the entire candle. The body's at the bottom of the entire candle. And this is what it looks like. So we actually have multiple examples here. And what's really great about this is your stop is very clear, and it's usually very tight risk, which is just pretty much at the high or slightly above the high of the candle. So if you're looking here, where it is you see that the currency pair is rallying, will make a new high, but it ends up closing at the bottom of the day's range. And then your stop is maybe 100 pips. Usually that's more than sufficient. And you can see in the days to follow, it moves a few hundred pips. And you've got at least the two examples I see here, one more to the left, to the red one, and then a few more to the right one. And I really like this setup a lot because you'll also been seeing it quite a bit on a regular basis. Like, let's see if we can find any on a euro. So this is a very recent euro one, where we had a few day rally, a shooting star, and a nice little reversal here. A few day rally, a shooting star, and this one's not as generous, but you could have still gotten probably 70 pips off of that. Pound dollar, we see fewer shooting stars here. This is a tiny shooting star, but you want it to be often a more exaggerated move. You can also see this on 4-hour charts. Like here, this is a huge shooting star pattern, a very, very deep reversal afterwards. No obvious shooting stars here. Let's take a look at dollar yen. Here, we actually have a shooting star that's attempting to form, although this looks more like a doji in dollar yen. That could be, quite a bearish candle. Aussie, I don't see any obvious shooting stars in the Aussie. This is a shooting star right here, but it happens, after a milder move, so the pullback is milder as well. And this is a doji, which is the next thing that we'll look at. A doji is very similar to a shooting star. It's an indecision candle, and it basically, unlike the shooting star, which has a body like this, it has a shaded color. The doji is pretty much an unchanged candle, and either way, it's an indecision candle for the currency pair. And you see this on this chart. You can see all these doji candles also representing points of inflection, indecision, and also what's really great about trading dojis is that your risk is very tight. So it's really, really ideal risk reward for trading with a doji. So if you look at some live examples, you'll see, we were just looking at the Aussie dollar. This is a really beautiful doji candle, especially on a 4-hour chart. And you also see a really nice kind of doji candle as well, and it just precedes, and these are 4-hour charts, so it's a slow trade, and it just precedes the breakdown in the currency pair. Even if you look at the Kiwi dollar, we can look and see if we see any dojis, or like here's 2 dojis, and 2 dojis is even better than 1. So 2 dojis, meaning that the market didn't feel like this breakout was real, and then it had a collapse. Some dojis here as well, but it's not really off of an exaggerated move. Let's look at daily charts. Here's a shooting star. It takes a couple of shooting stars before Kiwi finally breaks down. We'll have to see what this ends up closing at, but this could be the opposite of a shooting star. Another shooting star here. Not seeing any dojis, but that's okay. We can even try some of the yen crosses, a beautiful shooting star here. Some dojis, but takes a while. Doji, this also takes a little bit, but you can, even if you sold this and you stopped out, your stop, if you sold this, you were sold to 83.80. Your stop would have been 84.10, so a 30 pip stop, not a big deal. You try again the next day because you have a shooting star, and you don't get stopped out, and you get a really nice reversal that goes from 83.60 all the way down to at least 80.60, so 300 pip move. So this is the type of example where you may have a couple of losers before you actually get your winner, but when you get your winner, it could be a very powerful winner. So another setup that I really like is a evening star. An evening star is a 3-candle setup where you have a green or white candle. So you have a rally, an indecision, and a sell-off. So this one is very similar to the doji, except for you're looking for confirmation. You're waiting for the failure to happen and to confirm and to close before getting in. So this is a stronger signal because you're actually waiting for the confirmation, but you also, the downside of that is that your risk is greater. So in this example here, you've got your nice green candle, you've got your indecision candle, and then you've got your breakdown candle. And in this setup here, if you sold this, you sold at 83.15, and your stop would have been at 84.50. So obviously a much larger stop. In the example I have here, this is a cleaner example. But even in this case, if you waited for the green candle, if you saw the green candle, you waited for the indecision candle, and then you waited for the red candle, you would have sold around 112, I would say 60. And your stop would have been 113.40, so about 80-point stop. But when you get it, it can be really strong. And we can find these on a daily chart as well as on a 4-hour chart. I'm just trying to look for some new examples here. I mean, this could be example, but it's not really. I mean, this is more of a classic example here. Ideally, though, you want it to close near the low, whereas this is midpoint, so it's not as strong of a signal. But let's see if we see them on some examples on a 4-hour chart. So this is an example, not quite closing right at the low, but still you get a rally, indecision, and a close. Let's see if we find some cleaner examples here. And of course, these setups don't always happen all the time, which is why they can be so valuable when they happen. This is a similar setup, but not quite. And markets are dynamic, currencies are dynamic, so nothing looks perfect, but this is another example here. We have a rally, indecision, and almost closing at the low. The stronger, if it does close at the low, it's even stronger signal. I don't see any examples here on the 4-hour chart in dollar yen, but this is an example on a daily chart. A rally, indecision, pullback, but it doesn't really give you. Dollar yen is not really as good for a reversal. It tends to be more of a trending pair. Aussie, you could kind of say this is an example, but not a clean one. But it's a rally, indecision, breakdown, closing at the lows. This is a really good example. Rally, consolidate, indecision, closing at the lows. Now, of course, your risk on this one is really high because it's a big candle, but the probability of it continuing is very strong as well because that was a very big candle. This is a very clean example. Here, you have a rally, indecision, breakdown, and even breaks below this range. Very strong signal for a continued move lower in dollar CAD. Sorry, in Aussie dollar. So dollar CAD's got an indecision candle here. If we have tomorrow being a red candle, then that would be a confirmed break in dollar CAD, and that could suggest that we could have a more significant reversal lower in dollar CAD. Let's keep going with our setups. Another one that I like a lot that we'll see a lot of is a bearish engulfing after a strong uptrend, where with a bearish engulfing, your entire candle, the second candle, the entire body kind of engulfs the previous candle. So let's say you have a very nice rally, and then regardless of how big the green candle is, you get a really big red candle that kind of engulfs it. And that tells you that the market sentiment is changing. And this is an example. This is an example of an engulfing candle in probably the pound dollar preceding a very big breakdown. And this is good on the 4-hour chart as well as the daily chart. So let's see if we can find some of this. So this is an engulfing candle. Stop at the high, but it's not an uptrend. So this is an uptrend. This is a very, very clean engulfing candle, and then you get a reversal. This is not really engulfing candle. Let's see if we find another engulfing candle. All right, not seeing any engulfing candles here. Let's move to the pound dollar. Pound dollar just broke higher because one member of the BOE switched his vote in favor of a rate hike. So that's obviously pretty big news, and sending pounds, quite a bit higher. Pounds, this is an engulfing candle in pound. Let's see if we can find, sometimes you find engulfings on 4-hour charts. So this is an engulfing on a 4-hour chart in pound within an uptrend. This could potentially be an engulfing candle too, even though the wick is in the bottom. This is an engulfing candle. Pound is very guilty of having engulfing candles because it's such a volatile pair. Let's look at Aussie to see if we have any engulfing candles. This is kind of like an engulfing candle, but not perfect. This is kind of like an engulfing candle. 4-hour charts, not really seeing any engulfing candles, but this is a really nice over here bearish bearish setup that we saw earlier. Okay, so let's get to some trading strategies. I'll go back and come to some of these other setups because I think we've shown you a lot of what they look like on an uptrend, and then we'll come back and look at them on a downtrend if we have time. But I really wanted to show you some trading setups, and we'll come back to the short trades. So one of the setups that I really like a lot, and I use to trade every single day, is my 4-hour Bollinger Band turn trade. And it's a really effective way, in my opinion, to look for tops and bottoms. And I've been using Bollinger Bands for over a decade, and it is hands down one of my favorite technical indicators. And since we're looking at this on a 4-hour chart basis, there are definitely more opportunities than if you look at it on a daily basis. But looking at this, what we do is we first look for a pair to trade below the first standard deviation Bollinger Band. So what it looks like is you set up the Bollinger Bands in your charts, and in an uptrend, you look for where my arrow is pointing. You look for the currency pair to trade below the first standard deviation Bollinger Band, which means that it's in a downtrend. So it's trading below the first standard deviation Bollinger Band. It means that it's in a downtrend. Then what you do is you look for it to close above the first standard deviation Bollinger Band. So it's closing above the first standard deviation Bollinger Band, and that's what it looks like on this chart. So it's closing above the first standard deviation Bollinger Band, and then you buy. You buy with a swing low stop, target 1 to 2 times risk. So you buy with a stop, you buy with a swing low stop, so you're buying Eurodollar at 116.11, the stop is 115.30. So you're risking about 80 pips, and it's a 4-hour chart, so it takes a little while. It takes a few days, maybe 2 days, and then your 80 pip target, and because 80 pips is a good size move, your 80 pip target is hit at 116.92. And if you want to go for 2 times risk, you could, but it takes a good number of days for it to reach 2 times risk. But at the point where it reaches 1 times risk, you should probably move your stop to break even and trail your position on the remainder of the position. For a short trade, the setup is reverse. First, you look for the pair to trade above the first standard deviation Bollinger Band. So you look for the pair to trade above the first standard deviation Bollinger Band. So it's trading above the first standard deviation Bollinger Band, like the euro. Then you wait for it to close below the first standard deviation Bollinger Band. Closes below the first standard deviation Bollinger Band, and that's when you take the trade. And in this example here, well, I'll get to that in a second. Your stop is at the swing high and your target is 1 to 2 times risk. In this example here, you have the close below the first standard deviation Bollinger Band. Your first and second target, because the stop is relatively tight, your stop is only 35 pips, is hit very quickly thereafter. So sometimes, even if you waited for the big red candle, and sold at 117.80, you know, we all know where Eurodollar is trading now, you would have hit the target because it would have gone all the way down to 115. So I want to look at this because I really love it on a live basis. So let's add on our Bollinger Bands, and you can do this on any charting package. I'm just going to make this black. So this is my second standard deviation Bollinger Band, and then I'm going to add in my first standard deviation Bollinger Band. So adding in my first standard deviation Bollinger Band. So we're going to look at this. We'll start with the euro, look at this in the 4-hour chart basis. So there's a few examples that we see. This one looks like it would have failed, but it still didn't. I mean, if you bought this, you bought at 116.11. Well, maybe this would have 116.11. Your stop would be 115.50. So your stop is 60 pips. So it goes up about 40 pips and doesn't quite make it. But when you've got a series of red candles like this, it's probably not so wise to take the trade. You wanted to do it more out of an exaggerated trend. So here we go into the buy zone. This one's a very strong setup. But the best ones where you have a couple of hours, a good number of hours between the two bands. So this is a good number of hours between the two bands. This one sells. You could even wait till this one, and you sell at 117.80. Your stop is 118.40, so 60 pip stop. So 117.20 is your target, and so you know, this one, you have come within 5 pips of hitting your target. You could have also waited a little bit. Usually with this stuff, you know, I would say 50 pips. If you're in 50 pip profit, it's a really good profit. Here's another example. Closes above the first standard deviation Bollinger Band. Really nice rally. If we look at the pound dollar, you know, it's kind of doing that right now. If you look at the daily charts, you also, oh, sorry, this is a 4-hour chart example. If you look at dollar yen, you also see this. This is a sell zone. You close above the first standard deviation Bollinger Band at 110.08, stop at 109.50. So 58 pip stop, 110.08. So your target's about 60 something, and you would have hit the target earlier this morning. Here, a few candles above here, if it closes below it, let's say you sell 110.50 here, your stop is at 110.70, 20 pip stop, so your target is at 110.30, and you would have hit your target in this example over here. It works really nicely for dollar yen. It also works really nicely for dollar CAD after exaggerated moves. It likes to touch the 20-period standard deviation Bollinger Band. This is also an example where you may have a couple of losers before you have a winner, but when you get a winner, it could be quite a strong one. So let's move on to the RSI strategy. So with the RSI Swing Strategy, this is an even shorter term strategy. We're looking for this strategy on 1-hour charts. So we see the strategy, we're looking for strategy in 1-hour charts. And what you want to look for is you want to look for RSI so we're looking for a confirmed reversal. So we're not just looking for an arbitrary reversal and, you know, saying, okay, RSI is going to oversold territory, let's just buy. We're waiting for it to go into oversold territory and confirm to us that it's recovering before getting into the trade. So what that involves is basically you're looking for the RSI in an uptrend, so in a downtrend, to close below 30. So it closes below 30 here, but just because it closes below 30 doesn't necessarily mean it's time to take the trade. So it closes below 30. Then what you want to do is you want to wait for the RSI to close back above 50. So you wait for the RSI to close back above 50, and that doesn't happen until where my second arrow is. So in dollar yen on the hourly chart, the RSI quote unquote sets up when it's trading at 104.70. And then the RSI closes back above 50 at around 105. And then that's when you buy with a 35 pip stop and a 30 pip target. Slightly negative risk reward, but that's okay because we are trading hourly charts. And I hope you notice this, which is that when you get to shorter time frames, you want to go with tighter targets because the moves don't necessarily always extend to as much as we would like to see, basically. So here we buy with a at 104.97, stop at 104.62, target at 105.27. And of course, you want to pick the trades that ideally set up when it's a busier time of the day, either during the European session or during the North American trading session, for example. For the short trade, you want to look for the reverse, where you want to look for the RSI to close above 70. So here we have an example of the RSI closing above 70. So pound dollar rallies, it closes above 70. And then after it closes above 70, you want to wait for the RSI to keep falling and close below 50. So if it keeps falling and it closes below 50, that's when you want to sell. So here's an example of the setup, and the first arrow is where we get the close above 70. Second arrow is when we get close below 50, and that's when you sell the pound dollar 141.80 and 35 pip stop, 30 pip target. And in this example, the targets hit relatively quickly. So I like to use this on an hourly chart. I like to use it more if you overlay a moving average, where if you do get a move where it takes the pair beyond the moving average, so it shifts the trend, it becomes an even more powerful setup. And the last beginning tops and bottoms strategy that I want to share with you is on an even shorter term basis for those of you that like to day trade, and it's called the extreme fade strategy. It also uses the Bollinger Bands, but it uses a different combination of the Bollinger Bands. It basically uses the 2-period standard deviation Bollinger Band, and it uses the 3-period standard deviation Bollinger Band instead of the 1-period standard deviation Bollinger Band. So we take a look at this on 15-minute charts. The first thing you want to do is you want to wait for the pair to close above or beyond the 3rd standard deviation Bollinger Band. So when it does this, it means that it becomes an exaggerated move. So it rallies, becomes an exaggerated move, closes at or above the 3rd standard deviation Bollinger Band. If you think about what's happening at this time, when it closes above the 3rd standard deviation Bollinger Band, it's become it's 3 standard deviations above the average, which is very, very rare. And when that happens, that can tend to be very, very powerful. And that's really the setup that that you want, that becomes valuable. And this is kind of what a lot of hedge funds look at or think about, is because they want to look at or think about these setups that are very exaggerated. Then after seeing that, you want to wait for the currency to close back below the 1st standard deviation Bollinger Band, 2nd standard deviation Bollinger Band. So this is what it does. So what it does is it closes above the 3rd standard deviation Bollinger Band, and then you wait 2 candles later and it closes below the second standard deviation Bollinger Band. And that's when you sell. On a short trade, you sell at the open of the next candle. So we sold here at 123.83. Stop is the swing high in this case, which generally is about only 15 to 20 pips. And your target usually can go for 1 to 2 times risk, but because if the stop is small, you can typically go for a smaller amount of pippage. So you target 1 times risk and trail your position, or you can go for 2 times risk. Trail your position would just be once it moves to 1 times risk, you close your trade for half of the position, and then you trail it, seeing if you can get more, simply because the stop was so tight. So here we trailed the position 1 times risk, and then you can see that it actually only gives you 1 times risk, even though it looks like a very nice reversal. So here is another setup. It rallies, closes at the second standard deviation Bollinger Band. Then you wait for it to close below the second standard deviation Bollinger Band. You sell 123.37, stop at 123.45, and then you target 1 times risk on the trade. And if you wanted, that would be somewhere in the midpoint. You could trail your stop, and then it went all the way down to the Bollinger Bands on the bottom. But if you went for 2 times risk, basically if you went for 2 times risk, you would exit the trade, down where these candles are. So here's just some more examples here. This is an example of a short trade. The first arrow is where the currency pair closes at or below the third standard deviation Bollinger Band. It takes a couple of candles. You're waiting for it to confirm the reversal. It closes back above the second standard deviation Bollinger Band. You buy 141.65, stop at 141.45, and you have a really nice rally to the upside. Okay, so before I get to examples, I skipped a couple of slides that I just want to go back to. Before I go to questions, I skipped a couple of slides I want to go back to and just run through some of the other reversal setups that tend to work well. Double bottoms are very popular. You don't see them very often, but when you do see them, it can be very powerful. But also with the double bottom, these are finding long trades. Your stop tends to be quite significant. Cup and handles, you tend to see quite often. And what cup and handles involve is just some sort of bottoming, rounding out, then a breakdown, and then a break of the handle. And this is kind of hard to identify, but this is a kind of clean cup and handle setup where you have a sell-off, it kind of bottoms out, and then it tries to go again, but it doesn't, and then it breaks. Ideally, you want to break the beginning of the cup. The ones that are easier to identify are the hammers, kind of like the shooting stars. Very powerful setup, and we see them all the time on the charts. I think we saw some of them when we looked at live examples. The same is true of dojis. You see them very often on the charts, and they're very, very powerful reversals and setup to use to help you pick tops and bottoms. The same is true for a morning star, just as good as a evening star. This is a morning star setup. And then bullish and bearish engulfings are, hands down some of my favorite setups for picking tops and bottoms, because when you see the engulfing, it can be very, very powerful and can give you quite a good opportunity. All right, so with that, I'd like to open up the floor. Any questions you may have about anything that we discussed today? We only have 5 minutes. I apologize for that. But if you have more questions, I'm more than happy to stay a little longer.
Okay, fantastic. Thank you for that, Kathy. We do have a few questions here. Give me 1 second. One person asked, what do you find is the best time frame to identify tops and bottoms on?
4 hours. I love looking at the 4-hour charts. I love using it. I think that it gives us the most reliable, because daily your stops are too big usually. 1 hour, there's too much noise. So 4 hours, I think, is the nice midpoint, and I really like, and even 4 hours can help you use it as a guide into a reversal that may be happening on the daily charts as well.
Okay, fantastic. The other question that we have here, a good one, is, and it seems that they're talking about double tops or triple tops here. Let's say you enter sell on the second or third top. Where do I place my take profit?
So your take profit, so if we looked at, I think we had a really nice example in a chart of this. Let me go back all the way to the top. So I can show you here, triple top. So where do you put your target? Well, generally speaking, your target should be 1 times risk. But if your risk is 200 to 300 pips, if a currency pair goes above more than 150 pips in your favor, you should have moved your stop up, maybe plus 75 or something like that, and keep on trailing your stop in your favor to see how much you can get out of the position.
Okay, fantastic. Those are actually the 2 questions that just wanted to be covered there, basically.
Okay, fabulous. So I hope all of you enjoyed this session. You know, if you ever have questions, feel free to look me up or find me on Twitter and ask me. Thank you so much.
Fantastic. Thank you very much, Kathy.